All right, we got a great show for you today. Kyle Samani from Multicoin Capital is on the program. They made a massive bet on a crypto project called Solana, and that has become one of the greatest investments in the history, at least at this point. I don't know if they're liquid on it, in the history of all investing in the world, because they bought Solana, which has now become an Ethereum competitor, coexister. And this guy has got really strong feelings about Bitcoin and a bunch of other crypto projects. He's a very honest guest who's done incredible in crypto investing. We really double click on a lot of important issues. You're going to love this as an interview. And he's got strong opinions. But first, we're going to talk about the end of 996 at Bytedance, the makers of TikTok. As you know, 996 is the moniker for 9 a.m. to 9 p.m., 6 days a week. Basically the working style at Chinese tech and finance companies, which was modeled after how we used to work in the 70s, 80s, and 90s here in America, but we kind of deprecated that a bit. Well, now Bytedance has mandated that employees only work from 10 a.m. to 7 p.m., Monday through Friday, no more weekend work. They have to ask for permission to do overtime. Some weird stuff going on in China, and we're going to drill down, double click, and go deep on it. Stick with us.
This Week in Startups is brought to you by Squarespace. Turn your idea into a new website. Go to squarespace.com/twist for a free trial. When you're ready to launch, use offer code TWIST to save 10% off your first purchase of a website or domain. Drata. Don't let requests for SOC 2 compliance reports slow down your business. Use Drata to stay ahead of the curve. Go to drata.com/twist for 15% off. And Microacquire, the startup acquisition marketplace. Start the right acquisition conversations at your own pace. Get free and instant access to over 100,000 trusted buyers with total anonymity. Say goodbye to brokers and meet your ideal buyer today. Go to trymicroacquire.com/twist.
Okay, China's Bytedance, the makers of TikTok, has killed the 996 work schedule, and it's mandating that employees only work between 10 a.m. and 7 p.m. Monday to Friday. 996, if you don't know, was what people in China in the tech industry were working. That means 9 a.m. to 9 p.m. 6 days a week, which, by the way, when I was coming up in New York, in the media world specifically, were considered the hours. If you wanted to work at Condé Nast or the New York Times or any magazine, you're expected to get in the morning, stay till late at night. You would eat at your desk. You would order dinner in most nights of the week, or you go out to dinner. You might come back to the office afterwards, and you were expected to come in on a Saturday or Sunday, do 4 or 5 hours, and get ahead for the next week. The world has changed, obviously, and in China specifically, Xi Jinping has got a different worldview, and he's de-emphasizing, these celebrity CEOs like Jack Ma. He hasn't left the country in a long time. I think it's 2 years or so. And he is charting a new path for China, which is certainly more insular. And part of that is really getting into the social fabric of how people live their lives. We saw their video game changes and how much people are allowed to use video games. And now we're seeing work hours come in. Bloomberg reviewed an internal document from Bytedance. According to the article, the document would make Bytedance, quote, one of the first tech companies in China to officially mandate shorter working hours. Some of Silicon Valley thought the 996 schedule would push China ahead of the U.S. Sequoia's Michael Moritz, the greatest venture capitalist of all time, according to many, and the statistics. So it's pretty close to true. It's definitely top 4 of all time, Mount Rushmore. He wrote a Financial Times article back in January 2018, which was vilified by some on the woke far left. Silicon Valley would be wise to follow China's lead, because if we're going to be competitive, and there are entrepreneurs there who are working those kind of hours on very important projects, whether they're space projects or they're AI projects or healthcare related biotech projects, we do need to keep pace. And now we're seeing something different out of China. The Bloomberg article noted, under the new policy, employees can apply to work overtime no more than 3 hours on a weekday or 8 hours on a weekend. According to the document, they will receive extra compensation of up to 3 times their normal wage. For the overtime, permission to work overtime must be requested at least 1 day in advance. The article also notes that earlier this year, Bytedance, quote, canceled an alternating system where employees just take 1 day off per week every 2 weeks, which is crazy. 13 days of work every 14. That sounds like a recipe for disaster. On October 13th, Bloomberg reported the Workers' Lives Matter movement currently occurring in China. That's an interesting co-opting of Black Lives Matter. The movement included a spreadsheet where Chinese tech and finance employees shared, quote, what time they start and end their workday, as well as how many days per week they work. As of October 13th, the article had 4,000 entries, or I should say the spreadsheet had 4,000 entries. Right now, the spreadsheet links to a blank page, so it's probably deleted. It appears that this grassroots effort is working across a lot of other big companies. The sheet called Working Time has been viewed more than 10 million times, according to the South China Morning Post reporting. So very interesting. Workers getting a say, and maybe, it's hard to know what's going on in China and hard to know how this will play out, but definitely China is charting a new course, and everybody who's an expert on China did not see the decapitation of their top tech CEOs or the limiting of video games, the limiting of working hours as what China's new strategy would be. In fact, everybody thought the opposite. They thought China would out-hustle us, work harder, maybe be more entrepreneurial, take more companies public. So this certainly is something very weird that's going on there. And so we'll keep an eye on it. But for me in America, I tell everybody in my companies, if you want to be at a startup company, a finance company, I think a fixed 50, a solid 60 hours a week is what will get you ahead in your career. Don't want people working 78 hours a week. At this point in my career, I'm successful enough, the companies are successful enough that people, there are some people who I'm sure work 78 hours a week who just love it and are obsessed with their work and are super go-getters, but it is a recipe for burnout. And for me, at this point in my career, I'm trying to get people to stick with me for 5 or 10 years and grow and build their careers. If you want to keep people for 5 or 10 years, especially when they're working from home and all this burnout culture, if people want to punch a clock, they're probably not going to, if they do 40 hours a week, I don't think you're going to move forward in your career. You're going to maybe fall behind. If you do a fixed 50 or a solid 60 is the way I phrase it. You put that extra 10, 20 hours a week in. Self-improving, that could be reading a book, that could be taking extra meetings, catching up on the weekends on some email for an hour or two while you drink your coffee. Those kind of things are what got me ahead in my career, and different strokes for different folks. If you don't want to move faster in your career than other people, totally get that. I wouldn't work at a startup. I'd work at a big company because at a startup that might make you an outcast if you're not keeping pace. Now, some people are super wildly efficient. I've seen people work 40 hours a week and do more than somebody doing 60 or 70 hours a week where they're just hanging out at the office. But that's over now. Work from home changes this whole game. So, work from home, people can just see when you report on what you did this week, or you talk about in the staff meeting what projects you're completing, and everything's written down. So you kind of see in people's weekly or daily reporting what they're getting done. So I think the performative nature at staying at the office all hours, which I do know some people did. I certainly did that in my early days. I would come in early and I wouldn't leave until my boss left. A lot of times I was there and it's like 6 or 7 o'clock. I know my boss is going to leave at 9, and I'd say, what do I do for the next 2 hours? What can I do? And I go find a book about Novell networking or Banyan Vines or document management, and I would just teach myself a new skill. But I would never, ever leave before my boss or my boss's boss. Now, my boss would leave at exactly 5:01. They would literally be at the elevator 4:59, 5:01 to catch like the train to Long Island at 5:25. But I always looked at my boss's boss, who was Mike Savino, and I said, I'll leave when Mike Savino leaves. I'm not leaving until he leaves. And he would work till 8 or 9 o'clock. And then once in a while, he'd say, hey, what are you doing here, kid? And I'm like, I'm catching up on this. And I show him what I'm working. He goes, hey, you want to go get a bite to eat? We go around the corner of Manhattan and get a bite to eat. And that's how we started a lifelong friendship. And he mentored me, and my career made huge jumps because of that work ethic. So think it through if you're an entrepreneur. Okay, next up, my interview with Kyle Samani of Multicoin Capital. They've made a fortune, probably one of the best bets in the history of investing with Solana. But we also talk about how he has absolutely no interest in Bitcoin and that it's irrelevant. Pretty hot take there. Stick with us. It's going to be a great interview. You're going to learn a lot. From websites and online stores to marketing tools and analytics, Squarespace is the all-in-one platform to build a beautiful online presence and run your business. With Squarespace, you can blog or publish content, promote your business, announce upcoming events or special projects, sell products and services of all kinds, and more. No matter what the problem, Squarespace is the answer. You know that. And they have these beautiful templates by world-class designers, powerful e-commerce functionality, and everything you do is optimized for mobile right out of the box. You also got built-in SEO, free and secure hosting, and of course, their 24/7 award-winning customer support that you're not going to get if your cousin builds your website and puts it on his backup server, trust me. Back in 2020, we decided to create a new idea during the pandemic. We called it Remote Demo Day. We have founders pitch to thousands of angel investors over video conferencing, and we purchased the domain name remotedemoday.com and had the site up and running in minutes thanks to our friends at Squarespace, and Remote Demo Day has been a huge success so far. We've invested almost $20 million in this company. It's pretty great. So go to squarespace.com/twist for a free trial. And when you're ready to launch, use that offer code TWIST to save 10% off your first purchase of a website or domain. And congrats to the team for going public back in May. What an amazing journey. Great job, Squarespace team. Hey, everybody. Next up on the program is the co-founder of a firm called Multicoin Capital. And they were started in 2017. And they are currently, according to my sources, one of the highest performing, if they were a venture firm, highest performing venture firms in the history of venture capital, because they made an incredible bet on Solana, which is a platform that's competing against Ethereum and has done incredibly well. It's according to my sources, which you know are in all likelihood Billy and David Sachs, who talked about Solana on the All In Pod. It's a 100x fund. So with us today is Kyle Samani to talk about all things crypto. Welcome to the program, Kyle.
Jason, pleasure to be on the show. Longtime fan. Honored to be here.
Thank you. That's very kind of you. I know that a number of my besties were early supporters of Multicoin Capital. My friend Vinny Lingham, I guess, is one of your partners. He introduced you guys to the famous Bill Lee that nobody knows, who's actually the greatest angel investor of all time, the true GOAT. But since he's underground, I get to claim that title. And then my friend David Sachs, of course, from Craft, were anchor LPs in your fund. So tell us about what is Multicoin? Tell us about that first fund and the thesis for how you're investing.
Sure. So Multicoin Capital is an investment firm based in Austin, Texas. We have 15 employees, a few billion in assets across various funds. We have two primary fund structures we manage, a hedge fund and a venture fund. Craft was an investor in both of those vehicles. And we invest in crypto things. We invest predominantly in tokens. We do invest in equity from time to time, but are definitely token-focused investors. We have kind of three mega theses that we've outlined on our website, and those have been there for a few years and continue to guide our investments. And I expect these theses will continue to compound indefinitely. Those three theses are open finance, which is kind of a superset of DeFi, the Web3, and the opportunity for non-sovereign money. I think everything we have done falls into one of those three buckets. Although I will admit Web3 is a little bit broad, and a little bit all-encompassing. Today, between our hedge fund and our venture fund, although the legal structures are mechanically different, they're the same investment team manages both of those, and it's the same core theses across them. And in fact, there's a lot of name overlap as well between them. Our venture funds are typically higher risk, higher reward, more concentration in newer names. Our hedge fund is a larger, later stage entity that ends up holding a lot of the same names because we like to hold stuff that we like, and we like to hold as much of it as we can. And that's kind of how we do things.
And part of the idea is that you will run one of the nodes on these new networks, so you get to understand it. So you're actually participating in the formation in some way of these new projects, I guess is what we call them today. Not companies, they're projects, correct?
People use the term project, Tune Protocol, collective, DAO. I mean, there's a lot of weird names for these things. Running nodes is part of being involved in these systems, but I would argue it's actually somewhat of a commodity. We don't run nodes in-house ourselves. We work with probably 15 different firms externally to do various node operational things. And we work with 15 and not one because we want to be decentralized and help these networks stay physically and organizationally decentralized. I think the real value add we bring when we work with portfolio companies, or portfolio protocols, whatever you'd like to call them.
Projects, yep. Projects, protocols, and platforms. I guess the 3 Ps. I'm trying to understand this myself, but I get it.
Yep. But I mean, it comes from, I'd say, stuff that looks more like what VCs do. So helping with recruiting, helping with messaging, helping with strategy. And then I think a couple of things that are particularly unique to crypto, the most notable of which I would highlight is what I'll call engaging in crypto capital markets. Capital markets and equities, both public and private, they evolve over time, but they're relatively static at any moment in time. And because they're quite regulated, it's hard for them to change. Probably, for example, the largest change that's happened over the last decade has been the length of time at which private companies stay private. And in crypto, you have kind of the exact opposite phenomenon that's happened, which is these things go public, at 1 month or maybe like 6 months old. And that's a very different set of things that happens in the life of building something of value. It changes how you have to think about messaging and to constituents groups. So customers versus users versus speculators. Those are different constituencies, and like it's not always obvious how to think about balancing those different stakeholder groups. In particular, there's even the venues in which people trade these assets are obviously different. These are not trading on the New York Stock Exchange or the NASDAQ. And how do you, again, like even messaging, right? You don't have quarterly reports or 10Qs or any of these things. So figuring out the right kind of communication and cadence and format and strategy, thinking about exchanges, thinking about countries, thinking about languages, like this is just a very different set of problems. Right? Even most American publicly traded companies, I would venture to guess, have extremely few Chinese retail investors as owners of their equity. In crypto, that's probably not true. And so, young groups of people working on these interesting, hard problems have to deal with, these kinds of things. And it's very non-intuitive how to go about thinking about messaging and communicating and coordinating in this new capital market. Folks like us, who've done this 30, 40, 50 times, have seen what works and what doesn't work and can help those teams kind of figure out the right capital markets engagement strategy. I think that's one of the things we do that's particularly unique, and it takes years of doing this to kind of figure out how to really do it.
30 or 40 times, you've met a founding members of a project, a company, a team, a crypto project, and then been the first investor or amongst the first investors who buy those tokens in the initial token sale. Is that correct?
Correct.
And so how do you find those companies? Are they all hanging on a Telegram, or is it, on Discord servers, or is it just in a crypto community writ large? Yeah,
I mean, that's the way we source deals and get deals done is pretty similar to how most VCs do it. So we have networks, obviously, in the crypto community, other investors, other entrepreneurs. People are sending us stuff all the time. We know a lot of people directly, obviously, and they just message us and we chat. I love cold emails. My Twitter DMs are open, for better or for worse. So stuff comes in that way. There's hackathons, which, again, we attend and are kind of involved with in various forms. So the actual mechanics of sourcing are pretty standard. In terms of getting deals done, I would also say it's pretty standard. The only difference really between, I'd say, deals we do and traditional equity deals is these token provisions that are added to them. The token provisions are unfortunately not as standardized as I would like. And that's just the reality of teams being in different countries, LLCs versus C Corps, some warrants and other things. There's a lot less standardization there than.
So with a project like Solana, how did you find them? And then how did that initial token offering go down? How much did you put in? How many tokens were released? When did all that happen? Tell us the story of Solana.
Yeah. So I actually don't remember who introduced us to Anatoly.
Vinny.
But Vinny may have introduced us. So met with Anatoly at some point in April of 2018 while I was in SF for some other reason. I recall a few things about that first meeting. One, the title slide, the subtitle of the title slide said NASDAQ for blockchain. And I remember thinking this is very corny and like overplayed, but like, okay, you're making a very pointed argument or claim. And then two, Anatoly had a very different background than all of the other layer one founders I had spoken to.
What does layer one mean for people who are neophytes?
Yeah, so I mean, Bitcoin is a layer one, Ethereum is a layer one, Polkadot was kind of a layer one, Phantom, Bytedance Smart Chain, Polygon.
A layer one what? What does it mean?
A layer one blockchain. So this is the actual physical network of nodes that are maintaining a database that can run smart contracts of some form.
Got it. So when people launch a project, they can launch on a layer one platform, and that's where their tokens reside, and they don't have to build the infrastructure over again.
Correct. Yes.
Got it. Committing to security and compliance is vital for startup growth, and proof of security has never been more important. As you scale, you might start to receive more SOC 2 requests from customers, of course, and that's where Drata comes in. Drata is a compliance automation platform used by some of the world's leading CISOs. CISOs, you may have heard of it, Chief Information Security Officers. A lot of early stage startups don't have a CISO, despite the obvious importance of security and compliance. With Drata, you can easily meet requirements, support enterprise deal flow, and track compliance. Drata helps customers prepare for and clear SOC 2 and other audits, go from zero to audit ready in a matter of weeks. Take it from Philip Martin, Chief Security Officer at Coinbase. He called Drata's solution well ahead of other market players and said Drata provides users with the most advanced automation available. So here's your CTA. Check out Drata's 5-star reviews on G2 and see why companies like Clearco and SmartRecruiter work with Drata for their compliance needs. Twist listeners can get 15% off and waived implementation fees at drata.com/twist. DRATA.com/twist.
So Bitcoin was kind of sort of the original one, but Bitcoin is quite limited in what it can do. Ethereum is substantially more flexible and programmable, but has serious limitations around scaling and some other things. Solana is kind of an attempt at bringing the last 20 years of high performance computer science and distributed systems to a layer one blockchain. And the second thing that struck me about, I remember my conversation with Anatoly, is he's like, all I've done in my whole career is make things go fast. He's like worked at Qualcomm, at Dropbox, at Mesosphere, a few other places, and did that. And he was not academic at all, and was just like, I make things go fast. And that struck us as like, yeah, these distributed systems, like those problems in computer science have been understood for quite some time. And here's a guy who has been building various distributed systems for 10, 15 years and really understands them. And is just applying kind of this new crypto economic paradigm on top of that. Right. And that struck us as like a very differentiated kind of founder market fit.
And we had Anatoly on recently, episode 1302, for those of you who want to hear from him, from Solana's CEO. You guys then participate in Solana's initial coin offering or their initial token offering. I'm not sure what the term of art is today. I guess coin is not used because ICOs were kind of have a negative spin to them, but these tokens are released. You buy them for 4 cents, and you buy 100,000 of them, or $100,000 worth, or $250,000 worth.
You know, I don't remember how much we bought in the initial token sale, which was in May of 18. They did a subsequent round in August of 18, which we led, and then in 2019,
the company or in the tokens.
Solana Labs has never sold equity. It's so all were just token sales.
Got it.
We led the round in August of 18. In early 19, after the market crashed at the end of 18, a bunch of investors wanted to sell and get out. We bought out a whole bunch of those investors. We led another round in June of 19, and then bought out more investors after the token launched in April of 20.
Wow.
So we've been accumulating SOL across various entities at various prices from 4 cents to $1.20. And we've been buying more recently in the public markets as well.
And then you are buying these. It's a token, but it's kind of a security. You then, I guess, get to distribute them to your LPs in your fund, like I would an LP in the launch funds. And then they can sell them if they want to, if they can find a buyer, and then lock in a reward without ever having bought into a C corporation, a Delaware C corp, correct?
I'll agree with most of that, other than I'm not sure I'm going to call Solana security, but directionally everything else you described, I would say, is accurate.
Right. So how does one determine, well, it kind of acts like a security in terms of the LPs, right? They have this asset that's gone up in value. So I guess that's one of the big questions here. So then you distribute them and they get to sell them and get a gain if they want. How do you have custodianship of all of these and make sure that you don't get hacked or something horrible doesn't happen? And then when you distribute, do you actually send somebody's wallet a bunch of SOL? Or do they have like a custodian? And then how do you mechanically make sure that this stuff is safe?
Yeah. So
I don't know if that's a stupid question or a really important question, because we don't have this question in startup investing because it's just a cap table and some CFO somewhere will, make a change in it and it's all paperwork, et cetera. This stuff just moves on Solana as really fast.
Actually, I think it's funny you made that last comment about the CFO, because even in that, there's a lot of trust involved.
Sure.
In that system. And it's like, who kept all the PDFs and like made sure the Excel document got updated correctly.
Yeah. Wilson Sonsini, Cooley,
right.
A bunch of law firms who get paid $1,200 an hour.
Yeah. Generally, a good rule of thumb is if you can unbundle a function of a law firm and turn it into software, that's usually a good business to be in.
Yeah, they like doing that too. Yeah.
But yeah, so look, when we started, it was a lot worse. We self-custodied a lot of stuff back in the day. Today, if you read our LPAs do say we can self-custody because whenever new assets are created, sometimes there isn't an institutional custodian provider at the time of the network launch. So from time to time, we do have to take self-custody, and there's a whole set of processes we do around that. But at this point, 98, 99% of our firm's assets are custodied with primarily with Coinbase custody, as well as with BitGo and Copper, who are institutional SEC qualified custodians.
So those custodians will hold your stuff and charge you 1% of the assets a year or something, I heard, or 50 basis points?
It's much lower than that. I'm not sure I'm allowed to disclose their pricing, but it's 1% would be extremely high.
So it acts just like a venture firm, except these tokens can be used in the real world. So you explained the framework before. You have people who are working on the project. You have speculators, investors, and then you have people who use the tokens. Is that right? Those are the general constituents in these groups?
I think that's approximately correct, yeah.
And so with Solana specifically, what's the value proposition? Because it's not NASDAQ for blockchain right now, it's something else. What is it today, or did they actually meet that original vision? And why has it all of a sudden become one of the top 6 or 7 crypto projects? What was unique about this one?
Yeah, so again, Anatoly's original vision was, I want to run an order book on chain. This is well before DeFi was even a term. DeFi as a term was coined in about October or November of 18. And Anatoly kind of understood that blockchains are financial engines primarily, first and foremost, and that you should design a system from the ground up to enable price discovery is the foundational function of capital markets. And the way you have price discovery is you have an order book. Obviously, this is what NASDAQ and NYSE and plenty of other people do. So that was the goal from day one. The Solana blockchain launched on April of 20, so about a year and a half ago. And conveniently, right around the same time, a guy named Sam Bankman-Fried, who's the CEO of FTX, started to get real excited about DeFi and realizing it was going to change his FTX business as a centralized exchange. Started hacking around on Ethereum, was extremely unhappy with performance of the system, and looked elsewhere, and ended up picking Solana to kind of go all in on for 2 reasons. Primarily, one was the understanding the importance of the order book as the fundamental technical primitive that underlies all of finance, and 2, the focus on intra-shard scaling as opposed to inter-shard scaling, which is more or less what everyone else has focused on in crypto other than Solana. And that led him to build this thing called Serum on top of Solana, which is a decentralized exchange and an order book on the Solana blockchain. And that kind of launched in August of last year. And since then, that's kind of sparked a real growth in a DeFi ecosystem around Solana, and which has then led into NFTs and all kinds of other really interesting things.
So when you look at some NFTs are now trading on Solana because it's much cheaper to do that. There's less fees and it's faster. Solana's a hundredth or a thousandth the amount of time and money as Ethereum. Is that directionally correct?
Yes, all of that's approximately correct.
And then USDC, I just had Jeremy Allaire on the program because This Week in Startups is turning into This Week in Crypto. Jeremy Allaire on, he's doing USDC, a stablecoin that's basically following the rules. He also is on Solana, correct? So these two major use cases were a big part of how this thing grew recently?
Yeah, those two things really helped to get off the ground. Jeremy's background is not as much of a trading background, but he's really focused on payments. And again, he understands that absolute hard requirement is sub-second, sub-1 penny transactions. And if you're a payments guy thinking about enormous payment scale, those two things are paramount. And so that really drew him into Solana.
Microacquire is a startup acquisition marketplace that cuts out the middleman. Basically, that means they help startups get acquired efficiently. If you're a founder looking to sell, Microacquire is free, private, and involves no middlemen. You know how it is. You try to get a deal going. There's somebody in the middle. They don't care about the parties involved in some cases. They just want to close a deal. And you really have to wonder, who are they working for, right? You're always wondering about incentives there. Well, you don't have to worry about incentives at Microacquire. To date, Microacquire has helped hundreds of startups get acquired, and they facilitated hundreds of millions in closed deal volume. Their platform includes over 100,000 buyers, including me. I'm paying for the service. It's pretty great. There are thousands of startups currently listed for sale, and hundreds of successful acquisitions have occurred so far. Founders get free and instant access to over 100,000 trusted buyers while staying totally anonymous. On the other side of the marketplace, buyers like me simply pay $290 a year for access to deals on the platform, which means you're getting rid of the looky-loos, right? Unless you're serious about this, you're not going to pay the $290. So Microacquire helps startups find buyers. It's as simple as that. They'll help you start conversations that can lead to an acquisition in just 30 days for free. Just go to try.microacquire.com/twist. Once again, try.microacquire.com/TWIST. Is Solana overtaken Ethereum at this point in terms of where developers want to build, or is that, and where speculators want to speculate on a token? Those are two different groups of people, but I'm curious your thoughts on each one, because it does seem, we talked about the Ethereum Bitcoin flipping. They seem like two different use cases from everybody I talked to. One's programmable and, one is a store of value, but Ethereum and Solana feel like they're actual competitors. And people have been speculating, hey, when do these things flip? And what would be the case for that flipping? So, obviously you have a horse in this race, but give me your best impression of when Solana overtakes it. Because it looks like USDC is going to overtake Tether. So the idea that these crypto projects were going to maintain their positions is kind of ridiculous as a premise to begin with. So let's talk about first Ethereum versus Solana.
Yeah, and I also want to revisit the Bitcoin question too after that. In terms of speculation and just dollars, it's no question Ethereum is substantially larger, both ETH versus Sol, and then also the Ethereum-based assets versus Solana-based assets. That's primarily a function of age. I think Solana ecosystem is growing at a much faster clip. And I think I venture to guess, if you look at the prices today, the price of Sol versus ETH in terms of market cap is 15% or 17% kind of range. So call it a fifth or a sixth the size. So still has a long ways to go, but is pretty obviously compounding at a much faster rate for now. And I expect that will continue indefinitely. In terms of developers, it's harder to measure, unfortunately. There's no perfect way to measure these things. What I can say, and what I think most investors who are focused on the space will say, is there's a lot of developers they have spoken to in the last 90, 120 days who have gotten excited about crypto, who want to build in crypto. They look at Ethereum, they look at Solana, and they're just much more drawn to Solana because the performance characteristics of it, the fact that it's built in Rust, and there's just so many developers around the world who are big Rust believers. Solana is, every single line in Solana is written in Rust, and Rust is the flagship language for the SDK. And so Solana is piggybacking on that mega trend in computer science in a big way. Gaming people in particular seem to love all that stuff because they're performance nerds. And so gaming people are quite attracted to it. The other group that is extremely attracted to it is Wall Street and trading people. All of the Wall Street folks, again, this started with Sam and Alameda and FTX, but Jump Trading has gone very, very big in building on Solana. Jump is one of the largest high frequency trading firms in the world, and they've been quite public about a lot of the work they're doing. And in the last 6 months or so, you've seen various other large trading firms, publicly acknowledge Solana, and they're kind of implicitly buying Sol and doing other things. And so at a minimum, gaming groups and Wall Street trading firms have gotten quite excited. And that's really led to a lot of this developer activity, especially of spinouts of those firms.
So what's your position on Bitcoin then? Everybody, the Bitcoin maximalism and the Bitcoin toxicity movement are, on Twitter, which is not a real place, as Dave Chappelle will remind us, is pretty crazy. Like, they really are of the belief that there is going to only be one true. And if you don't buy into that thesis, then have fun being poor. What's your thought on where Bitcoin has, sort of carved a space for itself in the ecosystem?
Yeah. So among my peer set, I am almost certainly the most bearish on Bitcoin.
Why?
I don't think Bitcoin will be relevant in 5 years. It won't be worth zero. I just don't think it will be relevant.
So if it's not relevant, why wouldn't it be relevant?
Yep. So 2 reasons. Reason number 1, the value of having 1 million developers building stuff, doing cool things, onboarding users for various weird apps. Today, a reasonable person can look at Ethereum and Solana and say, this is a bunch of nonsense. There's a bunch of DeFi speculators and people trading shitcoin images of JPEGs. And this is dumb. And I understand how normal people can come to that conclusion at the current moment. In 5 years, it is so plainly obvious to me that there is going to be hundreds of millions of people doing really interesting, cool things with NFTs, DeFi, and who knows what else it's going to be. And everyone in the world will acknowledge that and recognize there is some fundamental value there. Meanwhile, Bitcoin and all of that action will be happening on Ethereum and Solana and who knows what else. But it won't be happening on Bitcoin. In 5 years, I'm pretty sure Bitcoin will look approximately as it looks today, because the point of Bitcoin is that it does not change. That is the defining feature of Bitcoin. I get why that has some resonating value. It is simple. There is some comfort in knowing that it's not going to change. But we don't live in an era of mean reversion. We live in an era of exponential software. Right. And every year that goes by, the older folks are passing and the younger people are controlling more and more wealth. And that doesn't feel software native. The world is clearly moving toward that digital native, software defined kind of venture type thinking. And so I expect with a very high degree of probability that in 5 years' time, any rational person is going to look at Bitcoin, they're going to look at Ethereum, Solana, and it's going to be one of these is irrelevant and does nothing, and one of these is the future.
Got it. So it's the feature set of the platform that will define its ultimate, role in the world. And if Bitcoin doesn't change, that's a feature. But if it doesn't change and it doesn't increase in price, and these other platforms are being used to create the next level of apps, it's almost like having an operating system with no apps. And then Solana and Ethereum are like iOS and Android. And you're like, well, why would I want to own this, whacked out app, this platform that doesn't do anything in the world?
Correct. So that's lens number 1. And then lens number 2 is, and this is where the Bitcoiners, again, really miss a few key things. All of the layer 1 blockchains, Bitcoin, Ethereum, Solana, etc., all of them have a native asset in their systems. That native asset is used to pay fees, to pay gas. And that native asset has some defined monetary system, some monetary schedule, supply schedule. In Bitcoin, it's 21 million, and it's obviously very famous and again, very simple to understand. Ethereum's has been undefined and is evolving, but is not perfectly defined. Solana's is actually, I would argue, much better defined than Ethereum's. It was 500 million at Genesis with a defined inflation rate. And so far, they haven't modified anything, and I don't think they will. The importance of the 21 million meme of Bitcoin is not the 21 million, The importance is that humans cannot change the supply schedule, right? That is really the key thing that you're optimizing for. And then secondly, and relatedly, you don't need perfect precision. Bitcoiners would tell you that if you don't have 9 nines of precision on the future of the supply schedule, the asset is worthless. And like, that's just like obviously wrong. Right. Every asset in the history of the world up until crypto has had like at best 1 9 of precision, like maybe 2 nines of precision, but like not even 3 nines or 4 nines. And the Bitcoin people are like, you must have 10 nines. And it's just like no. And so, yes, I agree. Ethereum and Solana's supply schedules are not as credibly neutral as Bitcoin's. Just because the assets aren't as old and a whole bunch of obvious social reasons.
When a new group of if Solana has this inflation, and I don't know what percent it is, but you tell me what percent it is.
It's like 7 or something right now, and it'll go down to 1.5.
So if that means they're going to put more coins out there to be sold at the market rate, or how does that work? Or is it going to be given to the? Yeah,
it's the validators who are running the network are receiving the inflation.
They're earning them.
So it's
not like there's going to be another coin offering that the project gets.
Correct.
But even if the project was getting something, wouldn't that be good for the project to have more resources, or does the projects not need any more resources? Because that's the one thing that I think is either inspiring or scary about these projects, which is who's in charge? Okay, it's decentralized. Nobody's in charge. Okay, it's become really big. Kind of would be good for somebody to be in charge if something went wrong. So we haven't seen something go wrong all that often. Of course, Solana famously went down for a little bit because it got a denial of service attack of sorts. Somebody flooded the network and went down for 12 hours or something. So for non-crypto people who worry about no central authority, what's the answer there?
Yeah, I mean, like that's the kind of defining thing, is that there isn't a central authority. Are humans a feature or a bug? I don't know. You tell me. Most people would say feature. I can make an argument bug.
Yeah.
But even that, I'll say it's not it's too simplistic of a framing. And actually, let's use Solana's network outage on September 14th as actually a good case study here. There was a bug in the system. It was actually a known bug that actually had a patch was written, but had not been deployed. And nonetheless, someone spammed the network went down. At that point, the core Solana engineering team obviously was trying to diagnose the issue. A bunch of people all over the world were also trying to diagnose the issue. Issue is diagnosed, patch is released in a matter of 2 or 3 hours. At this point, you just need a bunch of people all over the world who have to run these nodes to know what's going on, download the patch, install it, and reboot their computers, more or less. Turns out that took like 14 extra hours to do. And so, again, is that a feature or is that a bug? If the world depends on Solana, that's kind of a bug because 14 hours is longer than 3 hours. On the flip side, it also proves the point that the Solana team does not control the network.
Right.
Because they couldn't get the people to restart their damn computers and install the software.
Right. But if there's enough of them, it should create more redundancy, and there's a financial incentive for them to get their nodes back up and running, which is they're getting fees for doing transactions, et cetera. So
correct.
It's not dissimilar to ISPs. If an ISP goes down, they lose customers to another ISP, and they work to keep the internet running at Verizon or Comcast or AWS or whatever service you use. And I guess we've had some issues with, different infrastructures in the internet, but it's gotten better and better over time. Let's talk a little bit about this key issue that keeps coming up. Are these things tokens? Are they securities? And I know one of your portfolio companies got sued, and listen, anybody can sue anybody for any reason. But Definity, has been specifically sued by a California resident saying they violated the 1933 Securities Act, basically saying these are securities, et cetera, yada, yada. Without going into that specific case, what is the best practice today in putting these tokens out to make sure you're in compliance? And is the SEC done enough to make it clear what's going on here?
Yeah. So for Definity, real quick, we are small passive investors, and we're not close to the team. I have no insights as to the case or anything else. Can't say anything more than that.
Makes sense. Yeah. I mean, when you're buying this, it's not like you're on the board of the company. There is no company. There is no board in most of these cases.
Yeah. I mean, we were just a very small investor a long time ago. But anyways, so second comment I'll say is, Um, you know, investor protection rules are a thing. The substantial majority of investor protection rules in the United States were written in the wake of the Great Depression.
Yep.
Because during the Great Depression, people got desperate for money and started conning and scamming people to make money. Hence, most of the laws were written in 33, 34, and 40. And then the Howey test, which is kind of the test that really has created the bright line litmus test in the United States, was, I believe, 1950 something, right? And more or less all of the laws that are being used around investor protection in the United States, for the most part, were formulated in that period. The world has obviously changed a lot since then, most notably the internet and just general information awareness and ability to do due diligence and all those kinds of things. I generally am a fan of updating worldviews on these things, given how the world has changed. But obviously, I'm not in a position to.
What do you think would be, if you could wave your magic wand and say, hey, here's something that balances investor protections, KYC, money laundering, et cetera? What would be a fair use of this, or a fair proposal here in terms of trying to qualify these things? Because we all know that, yes, they can have the function of token, but as we were discussing earlier, there are people speculating on the token. So it's almost like an open, it's basically like an open cap table where anybody can participate freely, but doesn't have the protections of the NASDAQ or the stock market. Not that those are perfect either. What would be a reasonable way to do this if you were in charge? Have you given it any thought of what you would like to see?
So KYC AML stuff, I am in no way qualified to comment on. Counterterrorism, bank secrecy stuff, I have not the slightest clue. So I will reserve no judgment there. On investor protection stuff, I think, again, the primary question you have to ask, I say meta question, is what is the time horizon on which you are optimizing for at the social level? So if you optimize for maximum increase in overall economic output for the economy as a whole over an indefinite time horizon, which I think is the right time horizon to take at the social level, then you should be probably something that looks like close to no investor protection formally, if you want to go to that extreme. The question is, how do you balance the cost of introducing those protections on all of the good actors against the deadweight loss of theft and fraud from the bad actors, right? And that's like a fundamentally difficult thing to reason about because it's all counterfactual kind of stuff.
Yep.
My intuition is if you multiply any efficiency gains in the economy, 10 basis points, 50 basis points over, a base of $1 trillion or something, the answer is almost always just maximize economic productivity growth and economic value created. So I kind of tend towards that extreme. I realize I am not, normal in how I think about these things. But that's how I would approach the problem.
I'm curious what you think of my simple proposal, which is, maybe there's a sandbox when you're under X dollar amount in which you can operate freely. And then when these things become larger, 100 million, a billion, 10 billion, we add in some staged compliance that needs to be done. So that if there was a bad event, if there was a bad actor, like I would say Tether to me seems like a very bad actor given the fines they've been given. I think you probably agree, or anybody in crypto would agree, that they haven't acted with a lot of transparency. You can't get a project to 70 billion without transparency. So what do you think of that sort of basic proposal of a staged amount of regulation so that people can, have a playground, a sandbox if it's under 25 million or something?
Yeah. So, I mean, again, it's one of those things that sounds good in theory. The problem is, like, how do you do it in practice? Because, like, again, a network like Solana is very different than a network like Helium, which is totally different than a network like Graph or Audius. And, like, yeah, there's elements of these things that feel like companies. Like, obviously, you do have a core group of people who sit in the same room and talk to each other and, like, build software. And, like, yeah. But also, there's a lot of elements of these things that are really external to the core team. And the work output of those people, both labor and financial capital and intellectual capital, is fundamental to the long-term success of whatever the thing is. I find that securities laws today are too inwards facing, meaning they seem to assume that of the value that a team will create, the vast majority, say 95 or 99% of it, is being produced by some small group of people. And crypto is fundamentally about trying to flip that and say, what if the core team only produces 5% of the value and 95% of the value is produced by outsiders?
And captured by outsiders.
Yeah, it produced and captured by outsiders. And like, again, none of these things are 100-0 in either direction. But like, if you believe that that ratio can be flipped, which I really do think it's possible, then it really makes it difficult to even like, what transparency do you want from who? Like the data's on chain, whatever's on chain is there. There's lots of great data visualization tools, stuff like Dune, stuff like Nansen and others out there. What disclosure requirements should there be for the team? And even what objectives are you accomplishing? It's not actually clear how to reason about a lot of these things.
Let's talk about DAOs then. Decentralized autonomous organizations, sometimes referred to as DACs, decentralized autonomous corporations. These seem to have captured people's imagination. I'm getting hit up all the time. Hey, create a DAO for your angel investing, yada, yada. Create JCoin or, Angel Coin or something. And I think for a starting point, why don't you tell us why you think DAOs are important, if you in fact do, and what would be an application that you think could be a killer application of a DAO?
Yeah. So I think the simplest mental model of DAOs is that they're just LLCs. They're just digitally native LLCs, which is
limited liability corporations where you have partners in them.
Correct. And I think that model gets you like 90% of the way there. It's not fully complete, but it's actually pretty close. The biggest difference between DAOs and LLCs is it's a lot more easy to transfer ownership rights, obviously, in a DAO than in an LLC. Again, all the lawyer fees go to zero. You just click a couple buttons. And then it's also very easy to prove that you own some part of this LLC or part of this DAO, so to speak. And therefore, you can do things like privileged access, tiering hierarchies, community, token-gated discords, whatever. But it's really just an asset you can own, right? And that other people also own, and then you can work together. The notion of capital formation is not new. We had the precursor to the LLC was like what are those things called from the 1400s? Joint ventures or whatever.
Yeah.
Like that was kind of the first, real notion of like capital formation, I would argue, in the economy. Really something that kind of represents modern capital formation anyways. And like DAOs are just reducing friction, increasing access, making it easier to transcend borders and payment rails between countries, and then ability to get capital, all forms of capital together, financial, intellectual, whatever, to achieve some greater good.
How does one mechanically start a DAO? Is there an Amazon Web Services of DAO creation? If you form a venture firm, you just go to a law firm, or Assure and Carta and AngelList, of course, now have a platform for creating a fund, and they've abstracted and made it like Amazon Web Services, where somebody can just go create the registration documents, fill out a form, and basically they've taken half the work out of it, maybe 75% out of it, and the expense. How does one create a DAO today? Do you need to have a bunch of developers to write this code, and it's bespoke, or is there an Amazon Web Services yet of DAO creation?
Yeah, so the AngelList example you brought up is instructive, where AngelList is really focused on a specific type of fund entity thing.
Yep.
LegalZoom is like another interesting kind of comp here, where they make it easy to create LLCs of various forms and shapes. Yep. There will be different DAOs for different quote unquote types of functions, whether they're investing or collecting or whatever else. And so like there's a group of DAO creation and management things focused on managing an on-chain fund. So that actually is very nicely comparable to AngelList, as you just described it. There's groups of these things that are general purpose. So things like Moloch DAO, which you need to be more dev-y to use. And there's people working on other types of DAO creation tools for guilds, for these play-to-earn games and other things of this nature. Today, you still need to be a dev-ish to create one, but like it's just like copy paste some code and like throw it on a blockchain. It's like, doable in an hour kind of a thing.
So when we do this example, okay, go on.
In 12 months, I think there will be a lot of people creating a lot of DAOs who don't know anything about software engineering at all. Yeah,
I'd like to be one of them. And so because I have been so critical of ICOs and that sort of chaos, but what I'm seeing now is actually very serious people doing things by the books and being thoughtful about it, and legal frameworks starting to catch up with the technology, and then maybe some way to abstract and create some stability here. So let's go through an example here of a DAO. Has there been a DAO that's been successful, to the best of your knowledge, investing in non-crypto assets? Because it seems like a lot of the DAOs are, hey, let's all put X millions of dollars together and then we'll vote on which crypto kitties and, angry apes or whatever, monkeys and crypto punks to buy. Am I correct? That those have been kind of the pools of capital that have come together so far?
So most of the so I think what you're describing is generally accurate of most of the DAOs, but I think your framing of DAOs might be a little too narrow.
Okay.
DAO, I called it an LLC, which again is useful but incomplete framing. Decentralized is somewhat clear. Autonomous is actually, I think, the most interesting three of the three letters. Interesting letter of the three letters. Okay. Autonomous. Almost none of these things are autonomous, but some of them are. So Bitcoin is the first DAO, I would argue, where the DAO specifically is a game between people who are buying BTC because they believe in the 21 million meme, and miners who are mining BTC if and only if the cost of mining it is less than the current price. Otherwise, because you wouldn't mine BTC, otherwise you would just buy it.
Right. You'd be losing money.
Right. So
you don't need servers.
Right. But Bitcoin is the first decentralized autonomous organization where there are rules in the system that define how the system works, and then people are just acting according to those rules. Right? So in some sense, you could argue Bitcoin is the world's largest DAO, and I think it's a little bit stretching it, but you can kind of see where I'm going with that.
I do see where you're going with that. Basically, Satoshi set up a framework that cannot be changed, but then the people can operate within it in a collective to achieve goals. But because it can't be changed, as we talked about a little bit earlier, the Bitcoin maximalists may come to find a day when other platforms own all the apps. And why would you buy an operating system that doesn't support the breadth of apps that the other ones do, Ethereum, Solana, whoever? Yes. So continue. Yeah.
Yeah. So that Bitcoin's the first DAO, arguably. The biggest problem with Bitcoin DAO is the output of the DAO is nothing. It's you waste electricity on proof of work hashing. Yeah. The next, probably most interesting DAO at scale is probably Helium, where Helium, again, you have this mining concept and like similar to Bitcoin, but you have people who have built a physical network all over the world. There's, I think, more than 250,000 hotspots today. You can see the network live at network.helium.com. And
for people who don't know, this is a share your Wi-Fi router, earn cryptocurrency, and people are paying to get onto that Wi-Fi network. And they now have thousands of nodes buying these specific Wi-Fi routers. So if you had Comcast at home, you plug it in, and now you're earning cryptocurrency whenever outsiders pay for that. Kind of like imagine a decentralized Boingo. Am I correct?
Yeah. So directionally, what you're describing is correct. It is not a Wi-Fi sharing network. Today, it is a IoT network. So different set of radio frequencies. But generally, that's the idea. You can think of it as decentralized Boingo.
There's another one that's doing Wi-Fi, but this one is to do IoT devices. So if an IoT, and this is an acute problem for IoT, if you wanted to put into your IoT device something small like a radio, a watch or something, connectivity, you'd have to go cut a deal with AT&T to be on their little slurping network and pay per device $1 or $2 a month, and it just makes it not worth it.
Yeah, there's all kinds of problems with the AT&T and Verizon wireless networks. Yeah. And Helium is interesting. But coming back to your original question about DAOs, there is no Helium DAO in the sense that like there are other named DAOs on Ethereum and Solana. But if you think about Helium as a whole, what you have here is a set of rules about the set of rules primarily define the rate at which inflation is handed out and who inflationary tokens are handed to. People who are then buying hotspots to maximize the number of coins they can get. And that thing is autonomous. Like the rules are there. That there is some governance and the rules have changed a few times based on global input. But like, it's a DAO. I mean, like there's people have built a wireless network where no one owns the network. Yeah.
So then if the Verizons of the world, or what's really interesting about this, if somebody decides they're going to sue because they feel like, they're competing, which is what a Verizon or a Comcast might do in these kind of situations. It's like, okay, who are you suing? Some individual node owner? There's nobody responsible and everybody has started doing this. It's like a vast protest, and they're going to do 5G devices. So this is going to get really interesting really quick.
Yeah, Helium 5G just started rolling out like a week or two ago.
Oh, did it start real? Oh, wow.
Yeah.
So in this model, I would buy one of these 5G routers. I'd plug it into my Comcast at home. Comcast would never know. And then I'm letting people connect to that 5G, and I earn these tokens for providing it, correct?
Bingo.
Boom. And then Audius, which I think you also invested in, is doing something similar with music and sharing of MP3s and trying to make a distributed Spotify, essentially.
Yeah, I think today Audius is at 6 million monthly actives, but it's today primarily I'll call them music nerds. So people who are really into like discovering the latest tracks and like following artists and DJs. Today it's long tail discovery. We did not underwrite the investment assuming it like rivals Spotify and Apple Music. That seems pretty difficult to do. That may end up happening in 5 years, but
yeah, I mean, Wikipedia was told they would never get there versus Britannica. Yeah, ask a 20-year-old what Encyclopedia Britannica is. They've never held one.
Yeah, but even like, you know, assume the music nerd population is, I don't know, 1 or 2% of the population. That kind of feels right. Like
that'd be tens of millions of people.
That's still that's a great, really cool thing. So, we like stuff like Audius because it's enabling a new form of discovery and curation.
Yeah. So there is no AWS of DAO creation. That to me seems like an incredible startup that should exist.
I mean, it does exist in various ways. Fund focused ones, other multi-sig stuff. Party bid is one. They're not as easy to use as they should be yet, but I promise you, there's 20 teams fiddling in adjacent spaces around that.
Since you're an expert, can I pitch you my idea and get your candid feedback?
Let's do it, Jason.
Okay.
You're welcome to Shark Tank. Let's go.
It's kind of like Jcoin. I haven't rehearsed this, but imagine, I'm an angel investor. I invest in 100 plus companies a year. I set up a DAO. I say to the DAO, listen, I've been doing this a long time. I know what I'm doing. You can look at the track record. Here's all the proof. I'm going to set up a coin token that will, have 100 million of them come out a year for $1 each. And then I will deploy them into buying secondary shares, being a fund to fund into venture funds I have access to and companies I have access to. And I will do all that administration. You don't have to vote on the companies, but you can vote when we liquidate the assets, or you can vote if you want to take your money back or get more coins. And then every year we plan on selling up to 100, and it's a rolling fund. And you basically have access to this class of investments without ever having to be an LP and go through that process. What do you think? It's crazy.
Yeah, I mean, no, like this should exist. This exists today in very small ways. Some DAOs called like Pleasure DAO and Flamingo DAO and others are doing stuff like this now, very small scale. But I mean, people have been dreaming about this for a long time.
What's the name of it? The one you mentioned?
There's one called Pleasure DAO. It's a group of guys doing this. There's one called Flamingo DAO. There's a few, and I'll call them investment club DAOs. Some of the members, there's the Lao, there's Metacartel Ventures. I forget the names of all of them. But there's already people doing this today. Some members are voting, some members are non-voting. They all have kind of unique structures. People have been dreaming about what you described for a long time. You've got Funders Club, you've got AngelList syndicates.
Mine is the syndicate with 9,000 accredited investors, but I don't have a token associated with it. So what my accredited investors are always asking me is, hey, I invested in calm.com with you. I want to liquidate my position. Other people are saying, I invested with Calm with you. I think it's going to go 10x from here. I want to double down. And I don't have a way to let people trade it, but I would love to just say like, hey, just put it into the DAO and say, you want to liquidate at this price. And if somebody wants to buy your coins, all of the returns would then be abstracted into the coin price.
Yeah, I mean, LP secondaries in funds. Mm-hmm. I'm sure you've seen them happen over the years. They're not super common, but they do happen.
I've gotten pitched on them. Like a fund, what you're talking about is a venture fund will wrap up. Like when 500 startups started wrapping up their funds because they had issues at their firm, leave it at that. They were saying, hey, we're selling off my interest in 500. I don't want to be associated with it anymore. Or, hey, I've retired and I'd like you to buy my, assets in this other Acme Ventures or something. So yes, it does happen from time to time.
Yeah, but the process of doing it is extremely difficult. A lot of lawyers, a lot of paperwork.
Tens of thousands of dollars in legal bills at a minimum.
I mean, what's amazing about crypto is all assets get the same interface, which is in the case of Ethereum, the ERC20 token standard, in the case of Solana, the SPL token standard. And you can trade any asset on any piece of infrastructure, whether it's on Serum or Uniswap or whatever else. And so you just reduce the administrative and operational complexity of asset transfer and trading by like 100x. Like it really is that much of a reduction. And naturally, by doing that, it should become easier for people to trade LP positions in all kinds of right ventures and such. So yeah, this should exist. The world will eventually get there. A lot of friction between here and there, but it will.
Be
happen.
Really interesting in it is you take a market that is illiquid for a decade, and you would instantly turn it into a 24/7 marketplace. Like if you think about that swing, my LPs could be on the weekends having lunch with each other and trading their positions. You know?
They could. I don't think you'll ever go to that extreme, but certainly, like a lot of things that are unnecessarily illiquid should become more liquid, not like millions of dollars of daily volume, but like you can get it from, it takes 1 to 2 quarters to exit such a position to it takes 1 to 2 days to exit such a position.
Amazing. It'd be super amazing. What do you think about Tether? You see all these fines, you see all this craziness. Do you think that's, everybody says is a systematic risk for crypto? Take down the whole thing. When you see them getting banned in Canada from trading, you see them getting the New York Attorney General's fine. Now this $41 million fine. You see the way they kind of behave sophomorically on Twitter and attack people who are making basic questions, attestations from the Cayman Islands, all this stuff put together. And then you see USDC doing it really buttoned up with a publicly traded company with a banking license and all this other stuff they're putting in place and being dollar for dollar. What do you think?
Yeah.
And what is the, not only what do you think, I think an even more thing is, what do crypto people, when the press isn't around, you're having drinks at a bar, what are they saying about this? Do they believe it's a house of cards? Do they believe it's Fugazi? What's the back channel?
Yeah, look, so I'm not close with the Tether team. Don't know them personally. People have been making broad-based accusations of all kinds of nefarious things for 4 or 5 years now. Basically, all of those accusations have been either outright false or they were technically correct, but actually like practically incorrect. At this point, enough people have done enough business with them in enough volume, meaning like trillions and trillions and trillions of dollars of volume.
Yep.
That like it's hard to imagine there's any meaningful fraud here. Have they misrepresented things at times? For sure. Did they do so in the interest of the market? I would actually argue yes. I can't prove that, but based on my understanding of what they have and haven't done, they did it to protect the market, which I know is weird and has its own set of problems, but is not totally crazy. They clearly struggle with PR and comms and like have all of the wrong marketing instincts in every conceivable way.
You think?
Yeah. So I would not endorse their marketing strategies. But they have built a product and service that people want and like. Americans generally don't like it. Non-Americans generally do like it. There are a lot of people in the world that love the idea of having a US dollar without having any counterparty exposure to the United States government. And I don't know if Tether actually delivers that product or service or not, but there's a perception among millions of people, if not tens of millions all over the world, that USDT provides exposure to the US dollar without counterparty exposure to the US government.
But in fact,
that is like a fundamentally
6%.
interesting.
Yeah, it's interesting as a value proposition, but as you say, who knows if they live up to that with 6% of their holdings in actual US dollars and the rest being in these wacky commercial paper they won't actually disclose.
Yeah, again, they've done a bunch of weird things, and I'm not sure I agree with them or not, but they've been doing this for so long at such incredible scale. It's hard not to imagine like they are fully buttoned, like they are solvent. I realize they may have taken,
would be Bernie Madoff operated for 3 decades.
Yeah, so there are counterexamples in history.
Yeah,
everyone I know who has done, Tether does not directly face that many entities. They only face a handful of the largest trading firms in the space.
The offshore ones, right? Yeah.
Yeah, but I mean, even like, for example, Sam from FTX and Alameda, I mean, he has publicly said on the record, well, Alameda has done many billions and billions of dollars of volume with Tether and gotten dollars out of Tether.
Yeah.
And other people also have done billions of dollars of business with them. Also say the same thing. So, to the extent that people have tested the system, I mean, it has stood up to those tests.
There's a theory that I've heard, which is, they may have done a bunch of funky stuff, and they placed bets which they shouldn't have placed, but the bets turned out so good because they were so early. So if they took your USDT and they bought, crypto at, 5 years ago, 10 years ago, my Lord, they could be doing all kinds of crazy stuff because whatever the dollar amount is over the 70 billion is theirs.
Yep.
So if they bought Bitcoin at $2,000, $3,000, $4,000, $6,000 after the 20K crash, after that, when it went down to 3,000, I guess, my Lord, they could be sitting on 20x returns. They could have $200 billion in a bank account that they've swept. So nobody can complain because they're over collateralized, even though they're doing all kinds of fugazi stuff that if they showed it to you, you'd be like, oh, that's like my money manager going to Vegas and 10xing our money. Like, you're not supposed to do that, but they did it and it worked out. Therefore, okay, we'll pay the fines. Who cares? What do you think of that theory? And have you heard that theory?
I mean, I think that mental model has some truth to it for sure, based on even what they've publicly disclosed. Like, that is at least to some degree true. Is it 5% true or is it 80% true? I don't really know. But they are. I'm fairly certain they are solvent now. I'm not going to make any claims about future solvency.
Yeah.
But by all accounts, they are solvent now. They have been solvent for the better part of their history, other than a few weird moments in time where there was a hack and some other money was stolen for weird, separate, related reasons.
Do you hold Tether?
No, Multicoin does not hold any Tether.
Would you hold Tether? Would you feel safe holding your investors' money in Tether?
No, I mean, Multicoin is by definition counterparty exposed to the United States government because I live in the United States and I have an LLC here and other things. I have no interest in avoiding counterparty exposure to the United States government. So no.
Yeah, it'd be a good idea for you to be as compliant as possible given the changing rule set. Listen, you've been an amazing guest. Would love to have you on again. Congratulations on your amazing success.
Thank you.
One fund manager to another. And what's the next deal? I hear there's another deal coming next week. I hear you guys are closing in on a big one. And we can hold this episode to the moment after you invested. So if you want to, you have my word. We'll keep it confidential here. And you can announce this next deal you're doing. And we'll launch it the day you announce.
We do have a bunch of deals in the pipeline.
There's a big one coming. I know there's a big one coming.
There is a few big ones in the works. I don't know when they're going to drop, so I'm not going to make you wait here indefinitely for the news to drop.
Well, listen, if there's a way, I'm ready to start experimenting now. I feel like the crypto crazy period is ending and the legit period is beginning. So I'm ready to start experimenting and dip my toe in things. So if you have something that's interesting, I want to dip my toe and kind of start learning now. So let me know. And then whenever you announce, come back on the program and let's talk about whatever the newest project is and have that founder or founding team on. You've been a great guest, as I said, and continued success. And you're in Austin, Jason, and you're hiring or not hiring?
We are in Austin.
I know you're doing a big $250 million fund. I heard it's going to be wrapping up this year. So what are you hiring for? What are you looking for in professionals at your organization?
Investment team, we are hiring right now. Our job application process for the investment team is write an essay about anything in crypto and email it to me. The only requirement is it has to be as good as what is on our blog.
Okay, so beat the blog or better, and then your email is?
You can guess it.
First name at?
First name at. It's pretty easy.
So Kyle in the mailroom didn't get your email address. Okay, that's always my note to founders. Can I get that person's email? I'm like, first name at multicoin.capital. Might work. I don't know. I like that. I like that hiring model. Write a thesis, couple pages. That's better than a blog post we have.
Yeah.
Are you into the writing culture? Did you get into the writing culture as described by Amazon? The write first culture?
We are heavily write first culture.
I'm getting into it too. It is so much better. Why is writing first culture better with distributed teams and in 2021? Explain why it's so good.
Yeah. So specifically for investment team, it's particularly useful because we have people across 3 or 4 different time zones. Mm-hmm. The great thing about a Google Doc is 10 people can comment concurrently, but 10 people can't talk into a Zoom concurrently. And so it actually accelerates the overall pace of the conversation because multiple people can talk to each other concurrently.
It's better throughput. And then it forces specificity and forces clarity. If you make, it's much easier to make hand wavy, dumb claims while you're talking and ranting than it is while you're writing something down. You papered it. You have to have clarity and you have to take a position as opposed to the theatrics of some PowerPoint or just speaking on Zoom.
Jason, crypto is going to change the world. We're going to decentralize all of the things. Okay. That's how this is going to work.
I love it. All right. Listen, continued success and we'll see you all next time on This Week in Startups. Bye-bye.